Welcome everyone to today's webinar on preserving the singleness of money in conjunction with our member Fireblocks. So the background of the topic of this is very interesting, and I know it's not necessarily the most accessible topic for everyone, so we're going to try our best to break it down to make it as engaging as possible. And as with all our webinars, we hugely welcome audience participation and Q&A. I will be monitoring the chat throughout the panel discussion, so please do feel free to submit your questions. We will try and get through as many of them as possible. So in the future, multiple different forms of money, both public and private, and both those currently in use, as well as new forms of digital money, will coexist. Each has the potential to fill a different niche in the ecosystem and to provide enhanced consumer and business choices arising from their different characteristics, the technical functionality that they offer, the nature of their issuers, and their risk profiles. In order to achieve a diverse, competitive, and effective ecosystem for these new forms of digital money, seamless interoperability, convertibility, and above all else, preservation of the singleness of a digital pound in all its varied formats will be required. Just as bank deposits can today be converted into cash or e-money into bank deposits, the future evolution of money and payments will require equally seamless, trusted, and invisible conversion between cash, bank deposits, e-money, and other new forms of public and private digital money. In this event, jointly hosted by the Digital Pound Foundation and Fireblocks, we're going to explore this concept of the singleness of money and the practical ways in which it can be implemented through legal and regulatory frameworks, technical interoperability, and settlement mechanisms. We're also going to look at what constitutes money in this new ecosystem and the extent to which new private issuances and structures such as stablecoins can be considered to be money. We're going to kick off with a keynote from Varun Paul, who's Senior Director and Business Lead for CBDC and Financial Market Infrastructures at Fireblocks. He'll be presenting a keynote on the paper that he's published today on achieving uniformity of tokenized money through smart contracts. And following Varun's keynote, we'll then move on to a panel discussion with our lovely lineup of panelists. I think a couple are yet to join us, but we will be sharing links to Varun's paper after the webinar as well. All right, so over to you, Varun.
Thank you, Jana, and good afternoon, everyone. And thank you for joining us on this webinar on the future of money, and in particular on the singleness of money. I'm just going to try and share my screen quickly, and here we are. Okay, should we see? No. It's a very topical issue at the moment. The singleness of money, not least the provision of money from stablecoins and tokenized deposits, after the UK authorities published a series of papers on stablecoin regulation in the UK. As Jana said, my name is Varun Paul. I am Senior Director for Central Bank Digital Currencies at Fireblocks. And prior to this, I spent 14 years at the Bank of England, most recently working on the future of finance and on the digital economy, as well as on the future of money. For those of you that don't know Fireblocks, we are a digital asset custody technology provider. It's a bit of a mouthful, but basically that means we enable companies and financial institutions to securely hold and transfer digital assets. We're famous for our cybersecurity expertise, including in the use of multi-party computation to secure private keys. Now, that technology means that we can actually support a wide range of use cases in the digital asset ecosystem via the Fireblocks platform, supporting use cases from payments to gaming, from loyalty to tokenizing financial assets. And today I'm going to show you what we think is the state of the art in tokenizing money, building on a number of really interesting projects we've worked with the likes of ANZ Bank, National Australia Bank, the Tel Aviv Stock Exchange, and the BIS Innovation Hubs. Now, those of you that follow this space will have seen and heard of the Regulated Liabilities Network, and perhaps even of the BIS's Unified Ledger Framework. And you can think of the ideas and what I present to you today as a practical implementation of those ideas, and one which requires slightly less coordination, but one which also preserves the role of non-banks as issuers of payment tokens. So what exactly is the uniformity of money, and why do we need it? The uniformity of money is a very simple concept, but one that we take for granted. It basically says that £10 should be worth £10, no matter how we choose to spend it, whether that is a banknote, a bank transfer, a debit card or credit card payment, or even a stablecoin. And the truth is that even those forms of money that we use today have very different governance frameworks and very different risks associated with them. But as consumers, we don't need to worry about that at all. We just go about spending our money as we choose to. Now, the digital asset ecosystem of the future will likely be very diverse as well. It will go beyond the crypto and NFTs we see today to a plethora of tokenized assets, both the real world and financial assets. You can see in the top band in this diagram here. And just as we do today, we're likely to need a range of different forms of money, in this case, tokenized forms of money, to access these digital assets. In recent times, a number of stablecoins have faced challenges with credibility, and we have seen banks shown an increased appetite to issue tokenized deposits. And we've also seen an increased appetite from central banks to issue central bank digital currencies. Now, in a future where all of these different types of digital assets exist, I think we will also see a role for each of these different types of digital money. And we are likely to see them all find their own niche in a vibrant digital asset ecosystem. But in that future where they do coexist, preserving the singleness or uniformity of money has become a top priority for central banks all around the world. So to preserve that uniformity, we present a model of free convertibility between fractionally backed tokenized deposits issued by banks and fully backed stablecoins issued by non-banks. All of that backed by central bank digital currencies and governed by a central bank. We also present the smart contract logic and bring it to life with a real-time demo of these interactions on the blockchain, all built on top of the Fireblocks platform. So without further ado, I'm going to jump into that demo now. And we start with a simplified digital monetary system. It has a central bank at the top. It has two banks, Alpha and Beta, at the bottom, and a fintech, Gamma. Gamma, the fintech, is allowed to issue fully backed stablecoins. And it goes one step further by backing them programmatically with the CBDC. The banks backed by regulation are allowed to issue fractionally backed tokenized deposits at a ratio of 10:1. Each of the institutions here has customers, and we're going to see some of the interactions between these customers, Fiona, Charlotte, Ivan, and Alex, all while preserving this uniformity of money, so they don't need to worry about the backing models of the money they're interacting with. We're going to start the demo with a deposit to Fiona. And because Alpha Bank is allowed to issue fractionally backed tokenized deposits, it locks just 15,000 CBDCs in order to mint and issue the 150,000 Alpha coin into Fiona's wallet. So let's see what that looks like on chain. In each case, I'm going to show you the Fireblocks console and our new token studio to illustrate how this takes place on chain. We're going to kick off with Fiona performing with the Alpha Bank initiating a deposit action. And Alpha Bank's going to deposit directly into Fiona's wallet 15,000 CBDCs to issue the 150,000 Alpha coin into Fiona's wallet. As she clicks deposit, we're going to see that transaction take place on chain on the right-hand side. And you can see that we're going through an approval process and a signing process, all secured by Fireblocks technology. Within a matter of seconds, we're broadcasting onto the chain, and we'll get confirmation on the screen in front of us. And if we click on that hash, we can go and see that transaction on the blockchain, on Polygon mainnet via Polygon scan. We can see that we have locked 15,000 CBDCs in an Alpha coin smart contract. And created and issued 150,000 Alpha coin into Fiona's wallet. If we go back to the balances now, we can see that there are 15,000 CBDCs in the Alpha coin smart contract as expected, and Fiona is holding 150,000 Alpha coin. So now let's see what happens when we want to transfer funds to another party. Fiona wants to send 25,000 to her friend Charlotte. Charlotte is also a customer of Alpha Bank, so it's a simple transfer of 25,000 Alpha coin. And we're going to see what that looks like on chain. Once again, we're going to interact with the smart contracts here, and Fiona is going to initiate a transfer directly into Charlotte's account using her wallet address, and is going to send 25,000. When she hits transfer, we're going to see this action take place on chain. It's going to initiate an approval process and a signing process, all benefiting from Fireblocks' multi-party computation and transaction authorization policy. And when we look on chain, we can see that the 25,000 Alpha coin has been transferred to Charlotte's wallet address. We can look at the updated balances and clearly see that Fiona is now holding 125,000 Alpha coin and Charlotte holding 25,000. That so far is very simple. What happens when we want to transfer funds between institutions? Now, Charlotte wants to send funds to Ivan. She wants to send 70,000 to Ivan, but Ivan is not a customer of Alpha Bank, so he cannot hold Alpha coin. Therefore, Fiona has to burn the 70,000 Alpha coin in order to release the 7,000 CBDCs backing that Alpha coin and send it across to Beta Bank. But the smart contract, the converter smart contract, knows that there's a shortfall of 9/10 because of the backing model, and pulls the remaining 9/10 or 63,000 from Alpha Bank's reserve, sending the full 70,000 across to Beta Bank. Beta Bank, which is also allowed to issue at a flat fractional ratio of 10:1, then it only has to lock the 7,000, the 1/10 CBDCs into the Betacoin smart contract in order to issue the 70,000 Betacoin to Ivan. Once again, let's see that take place on chain. In this case, Fiona is going to interact with the converter smart contract. She's going to select a conversion from Alpha coin of 70,000 to Betacoin, and is going to select Ivan's wallet address. Fiona's the signing party, and when she hits convert, we're going to go through the same signing process. It was exactly the same for her in terms of she didn't need to worry about the backing model as she did for Charlotte. And in this way, we are preserving the uniformity of money. In a matter of seconds, we're seeing this take place on the blockchain, on a mainnet, on Polygon, and we're getting the confirmation that it has gone through. You can see there in this case, we've got multi-layers, and we can see every leg of that transaction take place on chain. If we go back to the balances, you can see there is now just 7,000 CBDC in the Betacoin smart contract and 8,000 in the Alpha coin smart contract. You can see that Fiona is holding just 55,000 Alpha coin, and Ivan is holding the 70,000 Betacoin that he was sent. You'll also notice that the Alpha Bank and Beta Bank reserves have moved in the direction of we expected by 63,000. You will note that the banking system here has not lost any money, but Beta Bank has a larger balance sheet with which to create loans now. Finally, let's see what happens when we want to do an asymmetric transfer from a tokenized deposit to a fully backed stablecoin. Ivan wants to send 40,000 to his friend Alex, but Alex is not a customer of Beta Bank. And to preserve the KYC and AML rules again, Alex cannot hold Betacoin. So Ivan burns the 40,000 Betacoin in order to release the 1/10 backing that Betacoin, releasing the 4,000 CBDC in that Betacoin smart contract. The converter smart contract knows there's a shortfall of 9/10 and pulls the 9/10 or 36,000 from the Beta Bank reserve, sending the full 40,000 CBDC to Gamma. And because Gamma has to issue at a fully 1-to-1 ratio, it locks the full 40,000 in the Gamma coin smart contract in order to issue the 40,000 Gamma coin to Alex's wallet. And again, finally, let's see that on chain. We're using the same convert smart contract with Ivan now initiating the transfer. He converts from Beta coin 40,000 to Gamma coin and selects Alex's wallet address. When he clicks convert, we go through the same signing and approval process on the right-hand side, benefiting from all of Fireblocks' security and the governance process. And it goes through on chain in a matter of seconds, despite the fact there are a number of steps in that transaction, all happening simultaneously. We get the confirmation that that has gone through, and we can see every leg of that transaction on the chain. If we go back to the balances, you can see now that there is just 3,000 CBDCs sitting in the Beta coin smart contract as expected, while there are 40,000 CBDCs sitting in the Gamma coin smart contract. Ivan's holding just 30,000 Beta coin and Alex is holding 40,000 Gamma coin. You can see here the overall balances from the perspective of the central bank. And those of you that are really sharp with your maths will notice that in this case, the banking system has reduced in size and has fewer assets with which to make loans. But in all cases, the most important thing here is that we have managed to preserve the uniformity of money from the perspective of the customer. They did not have to worry about the different backing models of the money they were interacting with. They were simply sending funds, and we were using the central bank digital currency in the background to settle. So we have shown that we can preserve the uniformity of money in a world of digital assets. And we've presented a model of free convertibility between tokenized deposits, fractionally backed and issued by banks, and fully backed stablecoins issued by non-banks, all governed by a central bank and backed by CBDC. The ideas in this paper should embolden central banks who are considering CBDCs to build those on the blockchain, knowing that the smart contract logic will enable them to achieve things like this in real time, at scale. It should enable the commercial banks to understand their continued role in this ecosystem as providers of credit, and it should empower fintechs to continue innovating on the future of money, safe in the knowledge that they do have a role in this ecosystem too. As Jana said, the paper is out today. You can use this QR code to download it, and I encourage you to do so, and welcome all comments. Back over to you, Jana.
Thank you, Varun. Can we stop sharing the presentation? Thank you. We did have a few questions, which I think a couple of them might be pretty quick and probably relevant at this point before we move to the panel. So someone asked if it would be possible to get a recording of this to watch. Yes, a recording will be available afterwards, and we'll send it around a link in the follow-up email as well as a link to the paper. We have a question on from Vivian on whether the central bank reserves on the main dashboard, as far as alpha and beta banks are concerned, are representative of tokenized RTGS reserves.
It depends how you think of it, but if there was a CBDC in play, then you can think of this as a wholesale CBDC. But I guess what you're saying there is a synthetic CBDC. Tokenized RTGS reserves would account as synthetic CBDC in my book.
And we also had a question from Andrew about, in these first examples, would the customer be able to custody tokens away from the institution?
Yeah, fantastic question. We call this non-custodial wallets rather than custodial wallets. And yes, absolutely. An extension of this paper, which will be for future work, will be to show that you can do this in a way that gives the customer full control of those assets without relying on the bank or the fintech in the sense of a financial risk. But they provide the interface and the wallet infrastructure to give them access.
Thank you, Varun. And so now we're going to move over to the panel discussion, and we'll start off with some very brief introductions. For those of you who don't know me, to start off with, I'm Jana Pache. I was part of the originating team behind the Digital Pound Foundation, and I'm now an executive director, and I lead on our policy engagement work. Elise, would you like to go next? Just a brief intro from everyone as to who you are and also what your interest is in this space.
Yeah, very happy to. So hi, everyone. I'm Elise Susi, Director of Policy and Regulation for GBBC Digital Finance, or GDF. GDF is the financial services arm of Global Blockchain Business Council, which is the world's largest industry association for the blockchain technology and digital assets ecosystem. I have a background working with both the public and private sector. I was previously at AFME, where I led digital assets work with capital markets banks, but also I was also a regulator and worked in policy and regulation at the Financial Conduct Authority in both their technology, resilience, and cyber division, as well as their international division on global policy. So I'm really interested in this concept as well from the global perspective, and how do we preserve singleness when we think about it on a cross-border basis as well. So looking forward to the discussion today.
Thanks, Elise. Ryan.
Thanks. Ryan Rugg. I'm Global Head of Digital Assets for Citi's TTS business. I joined a little over a year ago. We recently launched Citi Token Services, so looking forward to kind of sharing our journey there, as we're also part of the Regulated Liability Network, started that a couple of years ago. Prior to Citi, I worked at IBM. I was a partner in their America's blockchain practice, working on CBDC, digital assets, digital identity. So a lot to kind of share in that insight also. And then prior to that, I worked for a fintech startup for R3 for 5 years. So thanks for having me.
Thank you. Martin.
Hi, thank you. I'm Chief Product Officer at Quant. Been here about 3.5 years, and we're London-based fintech and blockchain startup. So we do quite a lot of work in digital money, and so DPF member. Prior to that, I've been at Vocalink, on the UK payment system side in technical and product roles since forever, about 2007, and then into the MasterCard merger as well. So my background is very solidly in the payments world. So I'm very interested in this. I've been for ages.
Thank you. Now, from a digital foundation perspective, this topic of around the uniformity or singleness of money is actually one that we've had in the back burner, as Martin will know well, for a couple of years now. So we're actually very excited in a very geeky way that this is becoming a more mainstream topic of conversation. And perhaps we can start off by exploring the topic in a little bit more detail. So one of the questions that we had from the audience is, why is the singleness of money a good idea? Shouldn't we be encouraging competition to provide features for the benefits of users of currencies? So perhaps a good way to start might be to look at what happens if the singleness of money is not preserved, and to start exploring the topic that way. What are the impacts if we lose that singleness of money across a single currency? Elise, can you give us some historical examples of when the singleness of money has not been preserved and what's happened?
Yeah, very happy to. So being American, I'm going to pick an example from US history, because I think there's a really interesting example here from the 1800s, just before what is typically thought of as, the Wild West period. There was a little different sort of Wild West in free banking. So in 1837, certain states changed how they offered bank charters, and it meant that virtually anyone could open a bank. So there were some rules. Banks had to back their issuance 1-to-1, which sounds familiar to some conversations we're having today with state bonds, but these were state bonds deposited with state treasuries. There wasn't any national or federal level consistency at this time. And so the result was that each state had an array of private banknotes which circulated as money. But, and this comes back, I think, to the question, which is they didn't trade at par from the issuing bank. So for example, if I had a note issued by someone in Tennessee, it might circulate at a 20% discount in Chicago, where I'm from. So during this time, the discounts were published in newspapers, the prices reported were secondary market prices. But there was a whole host of issues with this, because sometimes you had banks that either didn't deposit the bonds, or in some states where bonds were valued at par and not market value, they then defrauded the public by issuing notes they would never redeem. And counterfeiting was also a huge issue. But those fraudulent practices, while bad, were not actually the biggest impact or issue with this kind of breakdown in singleness during free banking. It was the economic inefficiency, because you had constant haggling and arguing over the value of notes and transactions. and trust was eroded, so that actually the delay and trouble of operations in that era were so much so that essentially deprived the community of the ease and efficiency of money itself. So to kind of wrap that up, the National Bank Act was eventually passed in 1863, establishing national banks in the US. They had to issue national banknotes backed with US Treasury bonds, and then subsequent legislation imposed really high taxes on the private banknotes, which means they were essentially wiped out, ending the free banking area. But I think to answer that question that popped up in the chat about why singleness is important, it's because without it, you lose some of that utility and the actual benefits of new forms of money. So singleness isn't about preventing new forms of digital money from existing or emerging. It's ensuring that they can all work together so that those economic efficiencies are still achieved.
And again, it's that goal that a dollar is a dollar, no matter what kind of form it's delivered in, whether that's commercial bank money, whether it's your bank deposit or it's a stable coin or it's cash from an ATM, and similarly a pound is a pound, right? And Martin, you had some examples, I think, of similarly what's happened historically when singleness or uniformity of money has not been preserved in the UK specifically, and also how historically we've treated this question of the singleness of money. So what kind of mechanisms have been put in place in order to preserve it until now, prior to the advent of new forms of digital money?
Yes. It was interesting because we didn't have the same sorts of impacts as in the US, but all of this was going on quite a lot earlier. So in the 1600s, there was a little bit like what we see now, an explosion of new types of what were at the time banknotes, but a variety of different types of banknotes from different types of organizations, goldsmiths becoming banks, that sort of thing. And so the same sorts of explosion of innovation and explosion of risk at the same time. So the biggest risks on these were a couple of things. So one was around, if you had a banknote, could you redeem it? Because once they started fractionally banking, then the reputation of the bank and the risk that you take into it starts to become an issue. And again, they might not trade at par. The other issue around that is really around, is the currency safe? Which one is the right one? Because at the time we're moving from currency based on kind of ounces of metal into pound sterling, and what's pound sterling worth if they're all different. And the other part was kind of an interesting political angle, because whenever you issue currency, you make money on it, whether it's notes or whether it's coins. And one of the commentators basically said the issuance of new money is essentially a tax on people that hold money already. That was going to a variety of different private companies, and it creates incentives which are not great in that market. So it was around early 1700s, 1708, that was kind of centralized, and sure enough, that is still a tax, it's seigniorage, but it goes to the treasury now. So this all kind of evolved in the same sort of way as we're doing now. So, so Jana, when I looked, I didn't find any major crashes or any big bangs that kind of caused an economic hurt, but the market evolution was really interesting, and kind of similar to what's happening today. So in terms of how do we maintain singleness, there's four major factors. So first one is kind of the seamless redemption, right? So we've got lots of different types of money at the moment. We've got anything from prepay cards to bank accounts to notes to all sorts. Can you change it from one into the other really easily? So can you take commercial bank money, which is not legal tender, either as cards, into something that is legal tender? Banknotes, yes, you can. It's an ATM. It's really easy. So that's very straightforward, and that needs to be preserved, right? Because if you can't, then it's not going to be as useful, right? If you've got something that's in loyalty points, you can't turn it back. They're not worth what they would be in cash. The other part of it is that redemption guaranteed, which it is, and that's something that the Bank of England have been very strong on, and that's been kind of in place for ages. That's one of the things that we just take for granted. If we've got money on a card or wherever it happens to be, we're not going to lose it, because we have the regulatory framework in place for that. the other part about singleness is related to that, and it's around acceptance. So if you've got something in one format and you want to spend it, you can seamlessly move it to somewhere else, or you can just spend it directly. And that cards come into this, and the card networks and card acceptance. And actually, there's a whole, we'll come back to it in a later question, but there's some big parallels there. And then the last one is really around functional consistency. And I'm absolutely stealing the term from Lee Brain, who I think is on the call, thank you. But having different forms of money be able to do different things kind of prevents the network effects that will lead them to success and ubiquity. And there's been quite a lot of payment systems that have failed like that. Some really interesting ones around this is the community currencies. There used to be a Bristol pound, which was backed against commercial bank money. Never really took off, eventually failed. But where we're introducing new functionality with stable coins, that we will need to reflect that back into other forms of money in order to preserve the singleness, because otherwise you've got a form of money that you can de-risk a transaction for you, and that has value, and then another form of money that cannot do that, and it has less value, so they're no longer worth the same. So yeah, there's a range of different issues. I shall stop now, Jenna, because you know I can go on for ages.
Thanks, Martin. That's really useful. And before we move on to how this all is potentially amplified and creates further challenges when we bring new forms of digital money in the mix, Ryan, I wanted to pose one of the audience questions to you, coming from a commercial bank perspective. Someone has asked, in the 19th century, a draft on Rothschild was usually more valuable than a draft on Barings because Rothschild was a better settlement risk. Isn't that a market decision for the user to make? I guess from a commercial bank perspective, why is it a decision for the user to make, and why is it a good idea or a bad idea for different banks' credit risk or settlement risk to be reflected in the value of the deposits or the liabilities against them?
It's a really interesting question. We've contemplated this a lot. We were one of the original banks that formed the regulated liability network with a group of 12 other banks, and the creditworthiness of each bank and how does this utility actually work. But, what we were trying to solve for as an industry was, always on 24/7, 365 settlement, having that programmability of it. If this happened, then that happens, payment and settlement simultaneously, as well as preserving that two-tier banking system. So it's really interesting because, the credit unions of each of the banks that were part of this, and the New York Fed sat in the middle of it. That's why it was called regulated. How does it actually work? And, we produced a white paper on the technical accounting financial feasibility of it and how it would actually work first one bank over the other, because you're seeing multiple commercial banks create their tokens, but that kind of defeats the purpose. We don't want another siloed banking system. We want kind of that more efficient one. So how do we work together? There's still a lot of questions around it. How you provide that true interoperability between multiple bank tokens. Other banks aren't going to hold liabilities of a different bank on their balance sheet. The creditworthiness of each, is it a liquidity pool that sits in the middle? So I think it's still a lot to that we're working through with regulators on this.
Thank you. So let's move on to some of those additional challenges and complexities that are introduced by digital currencies and new forms of digital money, and what they add to the mix when it comes to maintaining the singleness of money. So we now have the potential for different functionality to be implemented across different payment instruments. So a CBDC, a retail CBDC, for example, might have very limited additional functionality, but on the other hand, certain stablecoins or certain types of tokenized deposits might have as differentiating features, levels of programmability or specific functionality attached to them. What does this mean for the singleness of money once we have functional differences and potentially technical interoperability differences between these different forms of money? And how many different forms of money could we be seeing in the future, Martin?
I think what it means is we'll have to solve those things. So There, in terms of having different types of money that can do different things, this is quite new, partly because of where the ledger is. So if you look at the functionality in the payment instruments you've got today, it's out of the same ledger, right? It's your bank's ledger. You can have a debit card off of it. You can have a BACS payment, faster payment, check, all of that, but it's the one ledger. With stablecoins, there's a different ledger, and the programmability, the payment instrument is often in the ledger in a smart contract, and not actually a separate system that ledger's been connected to. It's still going to be connected to other systems, but we've got another layer of complexity. So I was kind of looking at where's this happened before and what happened. And if you look at the early days of the cards world, that's a separate ledger. Even now, they kind of are in the background, but no one really knows. And there was different networks, and different networks work for particular areas or particular countries or particular trends. We gateway between those networks now. Likewise, where we've got a card ledger, well, you see a shadow balance, that sort of thing, and your bank account, those things are kind of seamlessly linked. So when you use a debit card, you don't have to move that money. You don't have to redeem that into a card account like you would have done once, and then go and make a card payment and make it all back the other way. That interoperability is handled at this point, certainly for debit cards. Credit cards are a little different, but they're straightforward enough. So I think what we're likely to see is the same sort of evolution, right? So like with early credit card networks, they were really great, but they were limited in terms of the benefits you could get from them until they became kind of ubiquitous and global. And this difference in functionality inhibits ubiquity across all of it, really. So as we kind of move along this evolution kind of trajectory, what's likely to happen is a lot of the things that happen on stablecoin, we're talking a lot about them now, but they will get more and more invisible as they become more and more entrenched. Like you don't think about having a card balance if you've got a debit card. You just think you've got a balance. I think the same thing if you've got a bank account balance or your balance and you want to use it in a stablecoin network, that should just be another thing that you can do with it. You wouldn't need to manage a separate wallet or a separate funding. So very much the sort of thing that Varun's talking about in the background needs to make this super transparent. But likewise, money that's in conventional accounts now, bank accounts now, can be used on card networks. Money that's in conventional bank accounts now would need to be seamlessly used in as stable coins. So effectively, we would need to be doing this, buying the stable coin, carrying out the transaction, all the programmability happens, we get all of the benefits of that, and then we turn it back into regular commercial bank money at the end of it. So a lot of these things will be kind of hidden within the transaction in much the same way as the cards world, and I'm sure lots of other systems do as well. So that, I think, is where we need to get to. And yeah, as for how long it takes, that's a whole other question.
And at least one of the things we've talked about is all these different potential functionalities that can be implemented and the different characteristics that might be displayed by new forms of digital money. In the past, despite the fact that we have money from different commercial banks, it's all ultimately taken much the same form and been settled in the same way. Here we have the potential, maybe that a trading desk might value the settlement efficiency of a CBDC or a stablecoin above the non-digital format and price this in their trading of the form of the currency. And how do we prevent arbitrage happening on that basis, or is it a possibility? What are some of the other challenges that you foresee due to the different formats of money?
So I saw that there was a question in the chat about arbitrage as well. And, I think overall, I would say, similar to what Martin mentioned about there are going to be challenges with different functions and different, parts of interoperability. There are going to be arbitrage issues that the market is going to have to solve for. And I think the one that was mentioned in the chat is absolutely something that's going to need to be considered. I personally do not have the answer to that one yet, but I think, there are other things I would consider as well, because if you look at financial services beyond the digital assets universe, it's pretty clear that people will arbitrage literally anything, even in not particularly liquid markets. If they see any basis between index or synthetic variance, they will take that opportunity. So if you have a CBDC, let's say a digital pound, and then some other asset or derivative like a stable coin that has its value pegged to the same reference, also the pound, people are going to try to arbitrage any basis. And not to make this, even more of a concern, but, this could be exacerbated if, as Jana said, there are those settlement efficiency gains as well. But I will caveat all this by saying for those efficiencies to actually be priced in by a desk, you would need to have the infrastructure in place for those efficiencies to exist in the first place. So I think that while we're building the foundations of the infrastructure, we should be thinking ahead about these arbitrage risks and thinking about those solutions. But I do think that arbitrage in many different forms is a real challenge that would need to be overcome. And just to add one more dimension to this, is there's, a potential regulatory arbitrage question as well, and a question around what principles may or may not exist for settling in central bank money versus commercial bank money. So, principle 9 of the CPMI IOSCO principles, it mandates that an FMI needs to conduct its settlements in central bank money where practical and available, and if not used, then it needs to minimize and control credit and liquidity risk arising from the use of commercial bank money. But practical and available is an interesting phrase, because what if hypothetically the CBDC didn't exist yet, but the tokenized commercial bank money did? In this instance, it might be more practical to settle in tokenized commercial bank money, but does that meet the principle? Does it not? So I think back to your original question, at the end of the day, people always look for low risk ways to make returns, and then they lever it until the gap closes. I don't see why that would be different in digital assets, CBDC, or stablecoin markets. Be that a low risk opportunity from a basis difference or from settlement efficiency or even practicality. So I think this is definitely a challenge to be overcome, but the time to think about it is now, and for the public and private sector to work on it while the infrastructure is evolving.
Thank you. And I think going back to then how do we solve for this? How do we enforce that singleness of money? Obviously, Vern, your solution and what you've presented in your paper is one of them. And you've made very clear the role of CBDC in underpinning that singleness of money. Can you maybe reiterate a few of those points on why central banks, on how central banks can use CBDC across the financial system to preserve that singleness of money, especially in the context of new forms of digital money?
Yeah, I guess I come from a perspective that says the financial system in a given country is governed by the regulation and the central bank and the rules thereof. And so it's a good place to start. And I guess the point is that the central bank doesn't need to do everything. The CBDC doesn't need to replace all forms of money. It just needs to provide the anchor. And it's very similar actually to what the digital pound consultation says. It's trying to provide that anchor so that, as we've talked about, if you are holding different forms of money, the fact that you can always freely convert to the base form of money, the banknote today, and the CBDC in the future, gives you that trust, and it ensures that the departure, if there are departures for good reasons, as in I want to spend, I'm at a festival and I want to spend money, and the only money I have there in that ecosystem, I'm in there. As you come out of that ecosystem, the fact that you can convert back to the base money is the most important thing, and that preserves that uniformity of money. So even though there are small departures, as we just discussed, we're limiting that departure by the fact that you can always get back. And I think defining the rules in that way means you don't have to enforce everything. You're just saying you can spend your different forms of money. The fact is you have to always be able to convert to this thing which we're providing. And that's the principle upon which we present the paper. It's slightly less authoritarian. It says you don't need to have the whole FMI set out. You don't need to have the whole infrastructure on one blockchain or on a central ledger. We can set some rules as we have today to mimic the system we have today and we trust today. But it can enable all these other really cool use cases, including programmability by potentially from stablecoins or interest-bearing tokenized deposits and all sorts of really cool payment technologies.
Okay, and that's one approach to it. That's very much a kind of central bank-led approach. I guess you're a central bank and you want to maintain this across, your national currency. Then you can say, this is the system that I'm going to use in order to ensure this, using my CBDC to underpin that as the settlements mechanism. Ryan, your work in the RLN takes a slightly different approach, doesn't it? It's more private sector led for a start. And what are some of the key differences between the RLN's approach and the more central bank led approach that Vern's mentioned? And I don't think at this stage we're trying to say that one way is right or wrong or anything like that, but this is a very kind of nascent area of research and exploration, and it's really interesting to find out more and to bring to a wider audience the different approaches that are being taken and some of the benefits and considerations around each of them.
So we've taken a very client-centric approach, surveying our clients, listening to what they want, right? They wanted that always on 24/7 cross-border multi-bank like liquidity. So the way that we're solving for that is, we worked with the New York Fed and the RLN and a group of banks to kind of solve for that, right? With the Fed sitting in the middle with a group of banks, so the feasibility of it. But then we're also, last month we launched city token services for cash and for trade. And if you think you're a large multinational company that you manage money across the globe and you have, let's say it's 5 p.m. in New York on Friday and 5 a.m. on Singapore, typically you send money Friday morning before the cutoff in Singapore, so you can make payroll on Monday, or you could pay taxes, whatever the case is. So they have all these, liquidity trapped within all these different branches throughout the globe. So how do we solve for that? So that was one of the, kind of with the city token services, what we are solving for, but we don't want to create another siloed token. Then we're just recreating like the siloed banking system we have now. And that's why, with the RLN, we have different initiatives in different regions that we're collaborating. We think it should be, for the industry, by the industry, working closely with regulators as well as the private sector to kind of develop the right model of it. But, it keeps going back to what is the pain point you're trying to solve? What is the real pain point that clients are like feeling? And that's what, we're focused on, being a highly regulated institution that we are, like, we can't touch crypto or stable coins or anything like that. We're on a permission chain, but like that programmable money is really what clients want. If X bank account drops for Y, send money from Z, and being able to add that automation, but not just within Citi's four walls, within multiple banks, is really what we're trying to solve for our multinationals.
And ultimately, the RLN and Fireblock solution are trying to achieve the same end, aren't they? Which is enabling that settlement between different forms of a national currency and ensuring that preserving that singleness of money, right?
Yes. Solving the pain point for clients, just slightly different technical kind of approaches to the way that we're doing it.
Elise, I think when it comes to preserving the singleness of money, we've talked a lot about doing that within a single jurisdiction, but obviously there are additional challenges that come up when we look at value transfers across multiple jurisdictions and the complexities that this can introduce. What kind of cross-border coordination do we need, and coordination across the total jurisdictional ecosystem when it comes to regulation and interoperability in order to support individual jurisdictions in preserving the singleness of money?
So I think we've already seen some really great work on this from, for example, the FSB. They, in a publication earlier this year, they talked about how differing regulatory classifications and approaches to stablecoins at a jurisdictional level could lead to regulatory arbitrage and harmful market fragmentation. And I think that Vern and Ryan have both set out a couple of really valuable proposals for how the singleness can be preserved. But like you said, this discussion has to also operate at a global level, because no central bank digital currency that's a successful one, in my opinion at least, will operate only within its jurisdiction. You have to have the cross-border connectivity as well as the intercurrency interoperability that Vern mentioned earlier. And you have to agree on how those currencies will coexist across jurisdictions. Because if stablecoins, for example, were categorized differently in different countries, or the way that they interacted with different national CBDCs varied from country to country, you kind of lose that value of the singleness that you've preserved within one jurisdiction. Because say you have a privately issued stablecoin and a digital pound, and you set up all of the guardrails and principles needed for singleness of money within the UK, fantastic. Say you also have a digital pound and eventually digital dollar, and those are interoperable, and you have cross-border settlement. But what if there's a different treatment for stablecoins in the US, or they're not permissible, or they're not legal? Then in a sense, we're back to square one. And so I think this singleness issue is actually bigger than any one country. And it's really important for standard setters like the FSB to keep considering it alongside, for example, all the experiments being done by the BIS for cross-border CBDC settlement, to work on this together for the global solutions.
And I think I'd like to finish off by looking at some of the practical work that some of you have done in various jurisdictions. Ryan, you've had experience of implementing both the RLN and some city token work in specific jurisdictions. Are you able to talk to us a bit about those experiences and what some of the challenges and opportunities that you found have been?
Yeah, absolutely. So not necessarily with the RLN, RLN still in a proof of concept stage that we have, moving to phase 2 in several different jurisdictions of that. But from a city standpoint, with city token services launching last month between US and Singapore, from a regulatory as well as a legal, technical, accounting, we have a lot of experience in that, in the way that, tokens are viewed versus fiat. So, one thing that we did by design is we abstracted all the, complication of a blockchain from it, because to really drive adoption. So clients, we mint and burn tokens at the branch level by design. So clients will actually only hold fiat on their account. Again, we're trying to streamline processes for clients, not add more complexity. And, one of the feedback that we've gotten is clients have multiple bank accounts with Citi, multiple bank accounts with multiple other banks across multiple regions. Managing that is very difficult. So how do you streamline those processes? So again, making it as kind of streamlined as, possible. We've also had experience, in Nigeria with the Naira, like implementing that with the country and, kind of driving that and helping them, kind of succeed there. So a lot of different experience. And, in my prior roles also, from when I was at R3, a lot of the CBDC work that we did, that was actually the first project I worked on in 2015-16 with Bank of Canada, TD, RD, RBC, and a bunch of them. Now fast forward, it's interesting from R3 to IBM days, no two are designed the same. Some have wholesale, some have retail, have hybrid. What is the pain point that they're actually trying to solve? And what scalability does any one of them have yet? Are we just recreating these silos again? And how do we prevent that in the future? Because again, the pain point that we're trying to solve is that always on infrastructure for clients, frictionless. So I think there's still a lot of, questions out there as we kind of develop these different types of solutions. And, but I'll say from Citi's point, it's been, key for us to kind of work with regulators on this, on the journey, to make sure that we're doing it in a safe and sound way for our clients.
Thank you. And Vern, you also have some practical experience. So the demo that you showed us is not just a theoretical demo. You've kind of implements that as proof of concept in some jurisdictions. What have some of your learnings and takeaways been from those experiences?
That's right. So the demo is, it is a demo as POC, but everything it's built on has been shown in production in other use cases. I'll focus a little bit on Australia and Brazil. And the key thing I take away from those is the desire for interoperability. I think, as we've just said, it depends how you're designing your CBDC ecosystem for what purpose. And if in Brazil, it's no longer about financial inclusion because they have PIX and that's been wildly successful. It's more about, can we deliver smart payments and programmable payments in the broader ecosystem? So, they've chosen an EVM blockchain as a way towards getting something that can in the future be interoperable with whatever is built in the future. We know that central bank digital currencies will take years to develop. And so Australia was in the same place. Let's build on something that we know will be future-proof. And the idea that you can build on an interoperable standard like an EVM really gives them that mileage, and it allows other use cases to develop, knowing that they can't do the whole thing themselves, and that the private sector can come up with really interesting smart contracts to build on top of that basic layer. So I think those are some of the key takeaways that I've picked up from that, and it's a similar theme from the BIS work that we did on Project Mariana, where they were trying to bridge between 3 different currencies using 3 different blockchains, because that's a fundamental problem at the moment. The key requirement is to have a degree of interoperability, so that whatever comes in the future, you can make it work. And so these experiments are really good at showing that we can do that, and the state of the art does allow for this stuff today.
Thank you. And to finish off, I actually want to do a very quick work round, everyone, and answer Hamza's question. Do we believe that different assets, so CBDC, fiat-backed stablecoins, tokenized deposits, can coexist in order to create this need for the singleness of money in the first place? Would consumers care? Most don't know the difference between central bank versus commercial bank money. I think we can all get behind that. So 30 seconds each, going around my screen. Elise, you go first. Thoughts on that?
I love this question. I would say, yeah, consumers absolutely do not care. And they already have a pretty frictionless payment experience. So any enhancement to that would be the next step in actually getting them to care. But yes, I do think that these different forms of money can and will coexist. But I want to come back to something that Ryan was saying, which is it really depends on what problem you're trying to solve. We shouldn't be inventing new forms of money just because. They should actually, have a solution to a problem, not be seeking a problem and being a solution.
Thank you. Ryan, your thoughts on that?
Yeah, I totally agree. You shouldn't be like a hammer looking for a nail, right? It should actually be a real problem out there that, we're trying to solve. And again, if you start with that thesis, right, like that frictionless, I keep saying it, frictionless, 24/7, 365 programmable money, like the actual technology clients don't care about. It's been shown time and time again. They want the added efficiencies. They actually really don't care about what's the underlying tech or the utility that's allowing. If it's CBDC, stablecoin, crypto, tokenized deposit, it's like, and I think if you start with that thesis and really drive efficiencies for client, that's how you're going to, see adoption. I'll be full disclosure. I've been one in like my blockchain history that, blockchain can solve world poverty. We did everything. We tokenized IP, we tokenized, bonds, equities, but like the real issue, the real problem that clients are having is that frictionless commerce. And how do you drive that for an always on digital economy that we're in right now? So I think if you start with that, regardless of the underlying utility, is really what we need to solve as an industry.
Thank you. Martin, 30 seconds. Unmute.
There goes the first 5. Yes, I think is the answer. So there's quite a lot of forms of money that are already coexisting that consumers also don't know or care about. And as we get into solving for these sorts of things, adding programmability, it's new features. So yes, behind the scenes, they'll be coexisting. Consumers probably still won't need to care about them any more than they care about their difference between their bank account, card balance, and whatever else.
Vern, your final thoughts?
Absolutely, consumers shouldn't have to worry, but we have seen there are reasons why these different types of things exist today. We've got banknotes, we've got cards, and we've got e-money. And e-money is something I hold on to. People see a reason for it where they don't want to interact with a bank and have all the process that goes with that. And e-money providers can offer a lower barrier to entry and offer a really neat user experience without all of the bells and whistles of a bank account. And that has a role for certain people, for certain use cases. So I think people will demand different requirements. The point is they shouldn't have to worry about the backing. And that's exactly the concept. So Hamza, you're absolutely right. No one should care that they may have different needs.
Thank you to our audience, to everyone who's asked questions. Thank you to our fantastic panelists. We're out of time. We will be following up with links to Vern's paper and to the webinar video in due course as well. So thank you very much for attending and have a lovely afternoon.